Welcome to the Fintech One-on-One podcast, episode number 290. This is your host, Peter Renton, chairman and co-founder of Lintner Fintech. Today's episode is sponsored by Lintner Fintech USA, the world's largest fintech event dedicated to lending and digital banking. Lintner's flagship event is happening online this year on April 27 to 29, with the possibility of an exclusive VIP in-person component. The verdict is in on Lintner's 2020 event that was held online, with many people saying it was the best virtual event they had ever attended. Lintner is setting the bar even higher in 2021. So join the fintech community at Lintner Fintech USA, where you will meet the people who matter, learn from the experts, and get business done. Sign up today at lintner.com/USA. Today on the show, I'm delighted to welcome Stephane Lintner. He is the CEO and co-founder of Jiko. Now, Jiko is probably the most unique digital bank in all of fintech, and the whole offering is unique. How they approach it is unique. The way they got their banking license, is certainly very different. So, Jiko is a digital bank, but it's really it's got a very different focus, a different type of product. They're not interested in lending money at all. They're really more of a technology company that is providing sort of the rails, new kinds of rails to move money around very efficiently and quickly, and while also earning interest for their customers. So we go into the details in some depth. It's not intuitively obvious, but stick with us, listen in the episode, and you will find out how it works. It was a truly fascinating interview. Hope you enjoy the show. Welcome to the podcast, Stephane.
Thank you. Thank you for having me. It's a pleasure.
Okay, so let's get started by giving the listeners a little bit of background just to set the stage here, particularly focused on obviously what you did before Jiko. Can you give us some of the highlights?
Sure. It's pretty simple. I came from Europe to get a PhD in applied mathematics at Caltech. Never thought I'd be in finance, but was hired to price derivatives on the trading floors at Goldman Sachs. Joined in 2007 and then had a 9-year career on the floors, learning a lot about finance in general, and left in 2016 to start Jiko.
Okay. So then, how do you describe Jiko? Because it's not something that's very typical. You don't have a lot of companies that are like yours. So how do you describe it?
Well, if you describe the function, our business is money storage and access at scale. So the way we do that is by having a bank, having our broker-dealer, the treasury bill construct that your audience may or may not be familiar with. But really at the core, we've been trying to build, you can call it a bank, it's not really a bank in the usual sense, but a very safe layer where everything can store money, move it around really efficiently, creating this interoperability. So money storage at scale, that's one way of position us.
Right. And so then you keep depositors' money in treasury bills, I believe. So it's not exactly typical of what others do. Where did the idea come from to keep deposits in treasury bills?
So I'll tell you right now where the idea came from. It's just a little correction. The deposits are not kept in treasury bills.
Okay.
On the bank's balance sheet, right? It's really an investment. You as an end user, if your money is with Jiko, really you own treasury bills now. So there's really trading happening behind it, securities trading and clearing. You deposit, and then we invest that money for you in treasury bills.
Okay.
That's what makes us not a normal bank. We're both a bank and a broker-dealer, and the broker-dealer is where your money is stored in T-bills in your name. The bank is where the money comes in and the payments get processed, cards and all that good stuff. So the idea came from, as you just asked me, I worked on trading floors, and if you look there amongst banks, there is no such thing as cash. Because if you have cash, it means it's on a balance sheet, it's lent, you lend money to the bank then works it. So what banks actually clear with each other, the way you think about cash on a trading floor is treasury bills, securities that are issued by the government. They're safe, they grow when things are good, they grow when things are bad, they hold. And if you're big, it's the best thing you can have your money in because FDIC doesn't even apply. So we've seen it at scale and said, well, but if we want to make the financial system efficient, don't want to have all the constraints that a bank that lends normally has. If our only focus is to make things smooth and store money as a first layer, then why don't we use that? Why don't we do what corporates do, but at scale for everyone, small and big, hold T-bills instead of holding cash?
Interesting. And obviously the yield, even in a relatively low yield environment, is still going to be better than you get on your checking account or even savings account for the most part.
I get the question all the time. What's the yield? The answer is I don't know what the yield is, because it's whatever the treasury bill market yields. Just the same way you can't really ask a bank, what is the yield on a savings account? They tell you what they're paying today. They can't tell you what they're going to be paying in a month, because things is always subject to change. So it's not really the yield question. It's more, well, it naturally has yield when things are good. It's really a safe instrument, and it allows us to be an ultra scalable platform where we don't have constraints. And we can take millions of consumers or large corporates and match everyone and do a lot of really nice things on the payment side. So it's really the scale that the T-bills allow us to get, transparency, and yes, chances of yield when the environment has yield. And by definition, about at par or above most checking and savings accounts. That's historically how it works.
Right. Okay. So let's just get. I want to go and address this thing you did that was somewhat unusual. You're a fintech company. You hadn't really launched yet, and yet you went and acquired a bank in Minnesota, a small community bank. Why did you decide to buy a bank rather than going through the chartering process yourself, or what was behind that decision?
So there's two levels in that decision level. First decision was let's get chartered, let's be regulated, let's do this the right way. Very counterintuitive. Only Vero went really that way. A company like Square, it's only now that they've obtained an ILC charter. Mm-hmm. We decided from the beginning we want to scale, we want to inspire trust, bottoms up. So 3 ingredients needed for that: a licensed bank charter, a clean technology stack, and a completely different balance sheet model where you don't have the problems of having to do lending and all these other complicated things that a bank normally does that prevent them from scale. So that led to the broker-dealer. Then, knowing that we wanted to be chartered, we had a couple of possibilities: either apply for a new charter or buy a bank. We decided on the latter because the opportunity was there. There was this particular bank that we ended up acquiring was available, and a great price point and a great management team. So everything led to that. And also, if you're trying to deploy a new business model like ours, regulators, before approving a new charter or an acquisition, really need to understand what you will be doing and vet it.
Right.
The best way to vet it is to have an existing bank. You deploy the product in there, you show what you're doing. Regulators can see it at small scale and come and say, well, we don't like this, but we like that, and we would like you to do this better. And you build a trust over a 2-year process, and eventually you close the deal. That was really safe for us, because otherwise it would have been really difficult to demonstrate what we would want to do without having the charter yet. So it's very natural.
Yeah, that makes sense. So what was it about this particular bank? I mean, you said the price, the management team, but were you sort of dead set on going this route of having a bank, buying a bank? So, but what was it about this bank? Because I believe it's in Minnesota, and it's not exactly, you're not based in Minnesota. So what was it about the bank that really was appealing?
There was existing relationships. Some of our investors were involved with the bank, so we had a natural starting point. When we started talking, it was more to explore even the feasibility of what we wanted to do with this bank or another one. And then through the conversation, it became natural between us and their management team and their board to say, well, let's really do this. Let's do a pilot. Let's start approaching the regulators and get to a deal over time.
What was it like approaching the regulators? Because as I said, you're doing something that no one's ever really done before. So what were those initial conversations like, and how have they progressed over time?
They were very friendly from the beginning, very encouraging as well, supportive. I guess because our model is also clean. What we're doing is very easy to understand. It's relatively safe. We're not introducing systemic risk. We're not introducing technology risk. On the contrary, we're reducing it by having rebuilt everything in a modern fashion, by having a delevered institution that's really just focused on payments and money storage. So it all made sense. Then it was about saying, well, from there on, here's the next step. We'll we'll deploy, we'll do 5 accounts, very low volume, then we'll do 50 accounts, then we'll do 500, and all along at regular intervals, having visits from the regulators, the OCC or the Federal Reserve, FINRA, coming to inspect, give us feedback, and really look at our processes, because eventually it's all about risk management and your ability to anticipate risk as you build. So we did that all along. We built it into our processes, so we're safe when we deploy features now, is knowing what we're doing. We didn't have to reinvent the wheel after launching. It's all pre-built and baked in. So it was a very friendly relationship. It was thorough, very thorough. But ultimately, we believe that's good for everyone. It makes the product safe, it makes the platform safe, and we know we're going to be, as a result, we know that we can scale and not have issues where suddenly the regulators come and tell us, we don't like what you're doing anymore, because we have the dialogue ongoing.
Right. So is the community bank itself still operating in that same community?
Yeah. We've kept it operating the way it was. We are plugged into the community. There are plans potentially down the road to also have some overlap between what we do and what the community bank itself does. So we're on the board, and that relationship remains very healthy.
Right. So then I was just on your website earlier today, and I saw that you still have a waiting list, but you are operating, right? I've read you do have live clients. You just I presume you're just trying to kind of scale this carefully rather than sort of opening up the floodgates. So, like, what? Tell us a little bit about that process, about the scaling up from zero.
Yeah, so we have thousands of users live on the platform now. We've been clearing up the wait list relatively actively, so people who still want accounts can, especially now, can get onboarded relatively quickly, and the wait list is likely going to disappear very soon. It was a safe mechanism to make sure we control their onboarding flows at the beginning. When you control everything, it's fantastic, because you control everything. It's also very risky.
Okay. So I want to talk about the bank account itself and the debit card that goes along with it. Can you just describe how that works and some of the unique features that you offer?
So at the core, I like to use the electric card analogy. So it's still a card, so it comes with a card and it works with ACH and it feels like a bank account. It's just running in a different fuel. We're not using deposits. We're not doing all sorts of stuff on the balance sheet. We've invested you in T-bills. It's clean, and at 9 a.m. you can ask the question, "Where's my money?" And it's there in T-bills. We have nothing to hide. So it's clean and green in that sense. It's still a card. It has most of the features you would expect a card to have. In this case, the bank account. Right now, it works for individuals. It has the basic ACH and debit card functionalities. With twists here and there, since we control the stack, we're trying to focus mostly on your safety and your security to avoid you having to call us all the time or not knowing what's going on. So it's all about giving you some control. So if I have to describe two main things, on the ACH front, we've tokenized the whole experience. So instead of having one bank account number, that's your account and that's it. And when you have to, if that's compromised, you have to repaper, close, reopen, and call every single place that may have had your bank account on file. And nobody keeps track of that. I don't know how many, I didn't know until now, how many places actually had my bank account number on file. It's an amazing experience once you actually start relinking, where for each account, for each place you give them a new bank account number. We call it a portal. We like to think of Jiko, if you think about money storage again, it's a pod, your money is safe, and now you're connecting it via different rails, ACH, or give it a different address each time so that you can shut down that address when you want. And so that's what these bank account numbers are for. So we call them portals. So the account ships with at least 15, and if you need more, we'll happily consider that. 15 is kind of what we've all needed so far. So you get one to AT&T, one to payroll, one to the gym, and they're disposable. You can close them. So if you have a problem with one, that you don't have to close the entire account and then repaper. So that's one key feature. We haven't seen anyone with that, and it's really useful if you like to be in control of your finances. The second piece is the debit cards. So yes, we ship physical cards because that's still useful when your phone is off battery. No number on it, just like the Apple Card, to keep it pretty safe. And the card is the max swipe is which the swipe you're not supposed to swipe because that's easy to clone. If that happens, first you need to unlock it in the phone. It's a little clunky, but it really keeps you safe. Chip and pin, otherwise super secure. And of course, the ability to spin off numbers in the app if you need to make a virtual payment online. So we don't want you to use the same number everywhere. Same philosophy: stay safe, use different numbers, and configure around this. So the one feature I'll mention, you may have heard about, that in that spirit, and all of this ships with cashback. So when you use your cards, you get real rewards on debit at scale. You may have heard that recently we had one. We've created a flow allowing you to pay your taxes with the Jiko card.
I read that.
And that gives you, that works at scale, because we know where this goes. We know it's for the IRS. We have a special purpose virtual card in the app that you can spin off. And that number will only work to pay the IRS. But then on that one, we allowed high limits. And high limit, high reward debit has never been done. And we're getting quite some demand for that. Somebody paid 4.7 million to the IRS, got 47,000 in cash back. We didn't believe that's not subsidized by VCs. That's just the efficiency of our approach. So.
Right. Yeah, I read that. It was the 4.7 million on a debit card. That is truly quite something to see. So, okay, then. So maybe can you explain the mechanics? Let's just take that example for the $4.7 million. Obviously, this person had had money. You had the money in T-bills, and then they went and they paid the IRS $4.7 million. Explain what actually happened in that transaction.
So what happens in when you pay with your debit card is that any payments, debit card or others, your treasury bills get liquidated in real time. So you sell your investment, free up the cash as a result, and now you can pay. As a user, you don't have to do anything. You throw X, in this case, X $1 million in your account. You pay. It looks like a normal bank account. Now it's gone to zero or whatever the amount's supposed to be, and you see a new transaction for your debit card. And a few days later, at the end of the month, you get your cash back. So the difference with a bank, though, is that in this case, you're selling your own investment and you settle that in real time. It's your investment that you're liquidating, your T-bills. You've bought T-bills when you brought money in. You sell T-bills on the way out, and it's fluid. You don't have to see anything. It works at 2 a.m. on a Sunday morning. It works during on a Monday when markets are open. And we don't really care about how much goes in, goes out, since we don't live off the interchange. We don't have balance sheet. We don't have liquidity concerns. If all the money goes out tomorrow, we can make that happen. We don't have to go scramble to find the money, as opposed to a normal bank. That's why we were very comfortable with that transaction, that we can, if all our users run on the bank at Jiko and take all their money out, it's there. It's the T-bills that get sold. And
right. No, that is, and T-bills being probably the safest investment there is. That is really, because in many ways, what you're building is a much safer way to do banking. I mean, obviously a typical bank will loan their money out. They'll have real estate or small business or what have you. And if they have a run on the bank, that becomes a real problem. The FDIC gets involved, and whereas with you, it's a much safer system.
Yes, I think one thing that's important, though, because we talk to bankers a lot, and we own a bank after all, and that still does the traditional activity. You need credit in society, and banks that's what they do very well.
Right.
It's the lending side. And I mean, after all, this is lending. What we're really upgrading is the checking cash core experience that everyone sits on. After that, people should still, down the road, be able to invest in balance sheet intensive products, fund lenders. Right. So whether it's CDs or savings or structured notes or whatever it is, that's going to be required for banks to keep operating. And we're not really addressing that. On the contrary, we're just making sure that at the bottom, when it comes to cash for day to day, there's now a fluid layer.
Yeah, we couldn't have the entire banking system operating like that. It wouldn't really work. But so then, what is your business model? How are you making money?
So mostly as a platform. Right? So we what we've done and what we've exposed to the app will be available to other partners who want to embed the Jiko experience into their product. I mean, it works. Think about any merchant that suddenly wants to a value store. I'm not going to name any, but your favorite brands, there's a number of them that offer you to store some money with them to then pay. We can do that at scale. We can help them get much more streamlined paying experience and just let everyone benefit from what we've done. There's huge demand for that. In that sense, instead of the electric car, I like to make the analogy of the Dropbox of money. super scalable with APIs, and anyone can open accounts on your behalf, and then with your approval, and then create beautiful money experiences. So the platform will be our main revenue. We will charge for access and for account openings. But you as a user, of course, if you want to use our app, there'll be a free version. And we will have, because of what we've done, we think it's powerful enough that there's a beautiful product to be sold as well. We don't want to bleed either. So the current app is going to be tiered, and there will be a monthly subscription fee applying for a certain balance. We're still figuring out exactly where that's going to be.
Right.
So it's going to be both the platform access indirectly, so through partners, and we will charge them for accessing your money with your consent and all of that, obviously, offering you amazing experience in their brands while charging you for using the app directly fully if you want to use it as a primary bank account. If not, there's going to be a beautiful light version available for free for everyone.
Right. Okay, so I want to talk about this platform then. So are you going after like treasuries at companies, or are you going after other banks? I mean, or both? I mean, what's your sort of vision there?
Down the road, we can do a lot. We're not fully equipped to do everything, and we're still a small company. Right now, the main demand that we're seeing is from fintechs that look for, they're nimble, they've got a good ability to plug into APIs, they're designed for it. And most fintechs are not regulated, looking for a regulated partner on which to open accounts, store money, potentially issue cards within the value prop of that particular fintech. Each have a niche and a beautiful feature that they're rolling out in an ecosystem around it. There's still a need to store cash and create a banking experience. So we're seeing a lot of demand for that. So in that sense, that makes us the ideal partner bank. What's differentiated between us as a partner bank versus others is really that we have a single API that handles everything. When you work with Jiko, you don't have to go get a core provider, a core processor, and then a partner bank. It's one. And we scale. So when it's 500,000 users or multiple millions or multiple fintechs bringing a lot of flow, including big tech down the road, we have no scale issues. We won't have to recapitalize. We won't blow up. We're always going to be there. Right.
If someone could bring $10 billion to you and you could just handle that because the treasury market is just so monstrously big. And I see that. So then, I mean, it's really interesting that you've got this sort of your cash layer, because I could see that, there's, a lot of cash. I know that for our business, we handle cash, and it sits in a checking account earning zero right now. And is that, it just seems to me that you've got a consumer offering. Is this, Are we going to see a small business offering as well?
Yeah, of course, and even corporate down the road. We just have to grow carefully as we go. Right now, we've built everything for the consumer. That's who we wanted to serve first, and just create more universal access really cheaply. So we've done that. We're exposing it now. We're making it available to the general public and exposing it to partners who need that. The next iteration is what's the difference between that line is getting so blurred these days anyways. What's a business versus a person? So many gig workers or self-employed. It's really getting blurry. So fundamentally, it's still the same. You got to store the money. And in fact, the bigger you think, the more important what we've done is the more obvious it becomes that what we're doing is important, because consumers are protected of FDIC. Or do you really care of T-bills versus FDIC? Well, yes, it's transparent and comes with some yield, really. But if you have more than 250,000 because you're a small business and you have rolling cash, where do you put that? It's not FDIC insured above 250, and sweep accounts and all the complexity, you're not equipped. Put in a T-bill, start with that. That's your core primary layer, and then process your payments with that and match that versus your users. And you can rebuild a huge ecosystem that way. It's mostly papering when it comes to the controls. That's really what it's going to be all about. Large businesses means heavier volume, more money laundering issues, more onboarding questions as to who has access to the account. We're investing in it. We'll be ready for it at some point. Partners are already asking us for it. And ultimately, corporate cash would be at scale would be the final.
Right. So you say the treasury bills, and I think my understanding is that they're all short term. I think it's less than a year duration, right? And then you have there's treasury notes that are the longer duration, treasury bonds. You're focused on treasury bills because they're obviously the most liquid, but are you going to offer the longer duration products at some point as well?
The more sophisticated the client base is at the moment, meaning small businesses who can predict their cash flows with treasury or large corporates, yes, that's when you need to start opening up the yield curve to longer duration. For day-to-day retail consumer, T-bills is I have to be careful. I can't really say as good as cash, but that's pretty much that. And then anything above that would be really an investment that requires heavy disclosure and may not be suitable to everyone. But for small businesses, for corporates, yeah, they should actually manage and be able to go into 5-year bonds, 10-year bonds. They remain liquid. You can still sell them. I mean, 10-year bonds are extremely liquid. You can still sell them, but they have a risk now because as rates move, those bonds value move, and so you, as the treasurers and CFOs, will have to manage that. But there's lots of players who do that and can even cross-sell what we do, which is we would be the layer in power.
Right. So are you investing in like 30-day bills? I mean, what do you typically invest in?
So currently, we have discretion over that. Historically, we've been investing people in 1-year bonds and rolling those on a monthly basis. Because 1-year bonds within the T-bills are usually, the curve tends to be convex, so it's a good point to be in. It's still highly liquid, very low risk, but it rolls. And by rolling it, we keep you the highest point on the curve. Right now, there's really no difference between the 1-year bond, 1 month. So our team is most likely going to move everything into 1 month, wait, see what happens in the rate markets. All that is disclosed. So, but within the T-bills are maximum 1-year yield anyways. That's the
Right. Yeah, that makes sense. Okay. So tell me about the tech you've built is got to be somewhat unique. I mean, are you like, what's the size of your tech team? How have you kind of built this technology?
There's 15 people in our tech team right now, all in Reykjavik, Iceland. We went to Reykjavik to build this. It's the only country that threw bankers in jail after 2008. After all,
right.
So our what we're doing clearly resonated there. Well, I'm partially joking here. It just happened to be that my office mate at Caltech is from Iceland, Hannes Helgesson, and he joined us very early and helped build up the team there. So we have a really great team. We are now hiring in the US and creating a global team because we need to operate 24/7. And there's only so much you could scale out of Iceland, but it's been a fantastic place to start, and we have a great team there. Now, it's 2021. We started around 2016 prototyping. The cloud has matured so much that you can do a lot if you're not encumbered by legacy. And so that's why our team is actually that tiny, because setting up, you don't have to get data servers. You don't have to, between the Kubernetes infrastructure and AWS and everything that's been maturing between Google and Amazon, you can do so much extremely safely with regulatory oversight. You have to know what you're doing. Yeah, you need experts, but you can really operate with a very tiny team. In fact, safely, almost more safely than within your legacy, because we can just backflow from one zone to the other and everything that comes with that. So that's our team. It's going to grow. The architecture is pretty distributed. We've looked at the blockchain. We're not a blockchain company, but there's good constructs in there, and it's all about basically digital T-bills, and we focus very heavily on privacy. That's core to what we do. We're a bank after all, so we can't have fake accounts, but we also don't want to sell the data and have random access. So security, privacy is very important to us.
Right.
And, but people, if I may demystify one thing is, if you're at a bank and you have your ledger, and let's say you have only 10 clients, you could operate the bank without technology. It's called a book, and that's how Uncle Scrooge was making the entries. So in some sense, that's really all you need for a bank, or even if it's a broker-dealer of securities, you make the entries. That's how it used to work. That doesn't scale well. But that's really in the back, all you need is a database. You want to do that super modern with the latest technology. But the data models are well known, and it's not as complicated if you start from scratch. I think that's one very important message.
Right. No, I get it. Okay. And so you've talked about a lot of the places you're going. I mean, you're still in the early days here, but maybe we can end with, maybe you can tell us like some of the milestones that you're looking to hit over the next 12 months. Yeah.
We're razor focused right now on onboarding our first partners. We have a few that we're signing deal terms with, and they're going to do everything we can to power them up and be live before the end of the year. While, of course, talking to anyone who's interested about running on what Jiko's built towards opening up much heavier volume next year. So, but this year, opening up the platform basically while keeping on improving our direct product and making it as smooth and as fluid as the modern landscape requires. So really beautiful and safe experience where people feel that their money's just where it belongs and nowhere else.
Right. Well, it's really an interesting product. An interesting company that you've built here, Stephane. I appreciate you coming on this show, and best of luck to you.
It's a pleasure. Thanks for having me.
Okay. See you.
I love creative ideas like what Stephane and the Jiko team are doing. I mean, when you think about it, there's no reason why your money should be just sitting in a bank checking account earning zero. And in fact, you're getting charged for the privilege often to have that money stored there. I think what Jiko has invented a new way of doing this. I could easily see a point where something like this becomes the norm. Now, it's going to take many, many years, decades, in fact, if that ever does happen. Jiko is in a position to really take advantage of the, even though rates are low right now, it's better to get something on your money than nothing. And if rates start to go up a little bit, then it will become even more important. So I'll be watching their progress with great interest, and I think we'll be seeing a lot from Jiko going forward. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lendit Fintech USA, the world's largest fintech event dedicated to lending and digital banking. Lendit's flagship event is happening online this year on April 27 to 29, with the possibility of an exclusive VIP in-person component. The verdict is in on Lendit's 2020 event that was held online, with many people saying it was the best virtual event they had ever attended. Lendit is setting the bar even higher in 2021. So join the fintech community at Lendit Fintech USA, where you will meet the people who matter, learn from the experts, and get business done. Sign up today at lendit.com/USA.